Hey everybody, I hope everyone's doing well and had a good day. This is the Emini review for Monday, June 24th, 2024. And it's Monday, so the weekly chart first. And you can see the market's been in a tight bull channel since November of 2023. Over the past few weeks, we've had a 4-bar bull micro channel with a bad buy signal bar, and then a weak bull bar last week. The bar closed below its midpoint. So the odds are if we go above last week's high, it's probably more sellers above, and we may convert into a trading range. As far as if we trade below last week's low, and I think we will, and if we get below last week's low, the odds are there are more buyers below. For the reason I just said, it's a 4-bar micro channel, fairly tight bull channel from here, and overall fairly tight bull channel. Lots of bars above the moving average. The bears will have to do more. The bears need to make the market go more sideways, break a trend line, and disappoint the bulls before we get any deep pullback. And it's unlikely that a tight rally like this and a signal bar with a bull body like last week will lead to any major reversal. One of the problems, the bulls do have issues, and that is this 3-bar sell-off. This is the weekly chart. So for 3 weeks, the market sold off down, tested the moving average, and it ultimately bounced. But you don't get bars like this in strong bull trends. And so the market might be converting into a trading range. The odds were there were more sellers above this breakout, this bear breakout, sellers above here. And you can see we stalled here briefly, relatively briefly, but continued higher. But now the bulls, there's selling pressure, there's tails on tops of the bars here. We're probably going to come back down and test here at a minimum, and then maybe get to the moving average. And for the daily chart today, coming into the day, here's what we had going into the day. Tight bull channel, but over here, tight bull channel, trend line break, and like I said, we might be converting into a trading range. This looks like a leg in a trading range. This, as strong as it looks, if you look to the left, that's a problem for the bulls. And then look at this rally. It's a parabolic wedge. So up here the bulls are exhausted, and they may not look to buy until there's a deeper pullback. So what we have on the daily chart coming into the day is a high 1 buy signal bar above Friday's high. And you look at that high 1, and you have to ask yourself, are you eager to get long, and do you feel a sense of urgency? Or when you think about it, the reality is it's 3 pushes up. Climax, pause, buy climax, pause, buy climax, in what could be an overall trading range. And now you have consecutive bear bars, a weak high 1 signal bar. The odds are there are more sellers above Friday's high. And as always, going into the day, good to draw the prior day's high and low, important support and resistance. Today opened with a doji bar in the middle of a trading range. You look to the left, and if I say yesterday, I'm referring to the prior trading day. So if I say yesterday, because today's Monday, I mean Friday. We look at Friday, the prior day, and the market's in the middle of this tight trading range. Lots of overlap with the bars, 2-sided trading, fairly tight range. And then bar 1 being a trading range bar, there's probably more sellers above and buyers below. And then bar 2, we got a bull reversal bar closing on its high, but below the moving average. Still in the middle of the tight trading range. So if you buy above bar 2, you're being forced to buy with a stop order right in the middle of this tight trading range. It's never ideal. In a tight trading range, or any trading range really, You want to look to buy low and sell high. And in the middle is where traders look to take profits. So the bears who sold up here, they take profits in the middle. The bulls buy maybe below bars over here, they take profits in the middle. So we broke out below this 3-bar bull breakout, below bar 79 on Friday on bar 1, and then we are reversing up. Bar 3, a little bit of a surprise. It's a fairly big bear bar, but there's a couple problems with bar 3 for the bears. Even though it's a big breakout bar, you look to the left and we're still within this range. And what I just say about trading ranges, you want to look to buy low and sell high. And so I like to draw this. Maybe this is the range. I should make these darker. So here's our trading range. We have an upper third, a middle third, and a lower third. Look where bar 3 is. We're testing the lower third. That's the buy zone of the trading range. So traders who are short are going to look to take profits, and bulls are looking to buy to initiate longs. So you have both bulls and bears looking to buy in this area. Another problem with bar 3, I also like to draw this as a visual. You can imagine a gap down as simply a breakout bar. Gaps function the same way as breakouts. So if I can just make this black, it's basically something like that. And so you see, bear breakout attempt failed, bear breakout attempt, no follow through, bear breakout attempt. These are sell climaxes. Now we're getting into the bottom of a trading range. Might be a wedge. 1, 2, 3 pushes down. And you also have to take into consideration the fact that 80% of days on the opening range have a trading range open rather than a trend from the open. I'm going to clean up the chart now, but I like having those visuals to show you. So with bar 3, yeah, it's a big bear trend bar, but the context is bad. There's probably more buyers on the close and buyers below bar 3. And then 4, it's an inside bull bar, so no follow through on the bear breakout. But, and I say bear breakout, and it was a breakout. It's breaking out below several bars to the left, but look at the close of the bar, and we're still within these bars. So we're not breaking out of anything major. It's really a sell vacuum in a trading range. So bar 4, it's an inside bar, and it's a bull bar. Not the strongest buy signal bar, big tail on top, following a big bear bar. Probably buyers below the bar. But bears were disappointed if they sold the close of 3. And bar 3 is big enough, it may get a second leg, but the second leg is minor. And then instead, everybody bought on bar 5. So we had a tick gap, the market gapped up into the open of bar 5 and rallied really strongly into the close of the bar. It's a huge bull trend bar, but still minor at this point. You look to the left, it's a buy vacuum test to the top of a trading range. It's strong enough up and a big enough surprise that traders will not just sell. They'll wait to see what happens, whether the bulls get follow through, and it's strong enough for a second leg up. But again, it's not ideal to just buy the close here when you look at the context. You have yesterday's high, which is a magnet, but you know that there's probably more sellers above yesterday's high. And we're rallying, probably going to get there, go a little higher, but to buy here, you're buying high in a trading range. So probably better to wait. Follow through on bar 6. Bar 6 broke out above the prior day's high, but did not close above, and bar 6 is much smaller than bar 5. You look at the range, and bar 6 had a range of 6.5 points, and bar 5 was 13.25. So it's about half the size of the bar. So if bar 5 is so bullish, this is a strong bull breakout, Why wasn't 6 another big bull trend bar? Instead, it's a smaller bar, didn't close near its high, and could not close above the prior day's high. So there's problems with this bull breakout already. But still, 4-bar micro channel, strong bar on 5, big micro gap. Traders who sold above bar 4, they got trapped on 5. Really, traders who sold anywhere in here are trapped. But you look to the left and you know the market's in a trading range. So all of these trapped traders and the gaps that are open will probably get closed. So anybody who sold down here and scales in higher will likely avoid a loss and probably make money. And how do traders do that? Some might just wait for a bear bar closing below its midpoint and sell below that. Others might wait for a second reversal. But if you do that, if you sell anywhere, if you do something reasonable, let's say a trader sold above bar 3, fairly big bear breakout bar, should get a second leg, and then you get the surprise bar on 5. If you use a wide stop and scale in higher and do something reasonable, there's an 80% chance the market will come back to your average price and you can avoid a loss. There's a 60% chance it comes back to your original entry and you can actually make a profit on your second scale in entry. But as far as here on bar 6, is it by the close? Is it always in long? It might be always in long, but my concern is that the market's in a trading range. And whenever it's always in long in a trading range, it's time to look to sell. There's too much momentum, and it's a strong enough leg that it'll probably get a second leg. But because of the context, I want to see more. I want to see what the bulls can do above yesterday's high. And I mentioned there's already problems with this bull breakout. Another problem is the bar sizes. Look at the size of bar 4 and 6 compared to 5. Bar 5 is really climactic. It's like a small bar, then a big bar, then a small bar. It looks more like a buy vacuum in a trading range, and we know the market's in a trading range, so the bulls have to do more. 7, continuing higher, so good for the bulls. But 7, there's a fairly prominent tail on the high of bar 7 as well. So why are traders selling into the closes of bars if this is a strong bull breakout? The breakout is growing, that's good for the bulls, and now they finally have a close above the prior day's high. But if you look at this entire bull leg from bar 4, you ask yourself how much of the breakout is actually breaking out above something major, which is yesterday's high, because all of this in here is within a trading range. How much of this breakout is really breaking out? Well, if you look at, I don't know, maybe 75% of the leg is within the trading range, 25% is above, and we still need a follow through bar. But the fact that there's sellers into the close is concerning. And then a good bull bar on bar 8. Why are the bulls finally getting a good bull bar after they had a good bar, bar 5, but a weak bar for 6 was okay, 7 was okay, and then we got the strongest bar at the end. I say the end, after maybe 4 bars. That's always a warning that it's climactic, and it's a give-up bar. And it's the last of the weak bears exiting, the last of the weak bulls buying, just before you reach resistance and everybody starts to sell. So, big rally, and obviously the dominant feature of the day so far. It's likely to have a reaction, some sort of second leg. But because the market's in a trading range here, we may have to test the breakout point, which is yesterday's high. So bar 9, after the climactic bar on 8, we got an inside bar, and it's a bear bar on bar 9. Bar 9, it's an implied high 1 signal bar, but there's probably more sellers above the bar. It's a really disappointing bar for the bulls. So if we get back to the close of bar 8, any bull who bought the close of 8, disappointed with 9, they're probably going to look to exit. And that will cause a deeper pullback. And if you bought bar 8 and you get bar 9, You know that's a problem. And some traders may not even be willing to wait for the market to get back to their entry price, the bar 8 close, before a breakout test of yesterday's high. And then bar 10, we got another bear bar. It's technically a buy reversal bar. It closed above its midpoint. It's a high 1 signal bar, but the context is bad. 2 consecutive bear bars. There's problems with this rally. The market's overall in a trading range. Probably more sellers above bar 10. Disappointed bulls above, maybe scaling in lower, looking to avoid a loss. 11's an inside bar. Reduces the probability for breakouts. It was already a low probability breakout for the bulls above bar 10. And bar 11 only makes it worse because it's an inside bar, which means it's a trading range bar. The range is contracting. The context is bad. What about buying below bar 11? I would not. Even though it's an inside bar and breakouts are more likely to fail, you just had this strong rally, which could have been a buy vacuum, and you see this support here, the high of yesterday, which is the breakout point of this breakout. You know we're probably going to get there and test it. Maybe it's 2 legs down here, but this was tight enough. It's really just 1 leg, and then maybe we have a pause and then a second leg down. And then 12. A little bit surprising. It's a big bear trend bar, and it's a fairly strong bar, but the context is bad. It's above the moving average, and it's after this strong rally. I say strong. There's problems with this rally. I'll actually get into that. I mentioned earlier, after we had this small bar, big bar, small bar, the fact that the bars are not uniform in size is a problem for the bulls. The context is another big problem. You look to the left, how much of the breakout actually broke out? Less than half. And then you consider the higher time frame context, bad high 1 signal bar, consecutive bear bars on the daily chart. You know there's probably more sellers above yesterday's high. And if this was going to be, let me back up. If this was at this point, you know the market's either going to be a bull trend day or a trading range day. And then you get to bar 12, and you know you don't get bars like 9, 10, and 12 in strong bull trends. So at this point, more likely a trading range day, but still not likely to be a bear trend day. Because how many bear trend days start with a big rally like that? The answer is not many. 12 is a second leg down on 9 and 10, pull back and pause, and then a second leg. But it's a micro channel. Every high since bar 9 is below the high of the prior bar. So we have trending highs, the bears controlling bars, controlling price. But now we have a climactic bar at the moving average, maybe around 50% of the bull breakout. So there might be support here. 13, inside bull bar. But again, with inside bars, probably more sellers above and buyers below. 2 legs down, but still pretty tight. And it's still a micro channel, so probably sellers above 13 for a couple of reasons. You mix in the fact that you had bulls buying all the way up. I also should have mentioned this. Why is it a bad idea to buy bar 8, even if you didn't know that it's climactic? Actually, I want to use the other tool. It's the trader's equation. And when you look at the risk reward, your theoretical stop at least goes below the breakout. And here's your profit target if you're going for 1-to-1. And if you're going for 1-to-1, you need 60% probability at least. And maybe you can argue it's 60% on the close of bar 8. But what about now on bar 9? You know there's probably sellers above bar 9, and you mix in everything else I've been saying about the daily chart context. Just look at the prior day's price action, probably more sideways. And then this, you know it's not 60%. We're getting up here before we get down here. And so at some point, the bulls who bought here, maybe they're scaling in lower, but they know We may not get back to the original entry price at bar 8, but maybe, if I scale in lower, I can avoid a loss by exiting at my average price, which will be the red line, and we'll see what happens there. So this red line, if a bull bought the close of bar 8 and then bought more above bar 13, which by the way, it's really not ideal to be doing that. You probably could have, as a bull, 2 legs down, 50% correction, moving average support. Bulls are buying the close of bar 12. And then look where bar 13 went. That's the midpoint of the two entries. But anyway, let's say you did buy above. 14 is another bull bar, but it's a small bar, still within the range of bar 12. And after a big enough disappointment by the bears, it's big up, big down, and big confusion. And this is disappointing to the bulls, so the bulls are contributing to the sellers above. This finally broke the micro channel, and we're expecting sellers. And then 15 turned back down. 15 a bear trend bar. The bulls probably hoping it's a wedge bear flag, maybe 1, 2, 3 pushes down. But the bulls need a good signal bar on 16. And then instead we got follow through for the bears on 16. Bear trend bar, so bear breakout 15, follow through 16, and good bars, little overlap. If a bull bought below 14, they're trapped. You start thinking about the earlier prices where I said traders were trapped. Maybe a bear sold above bar 4, it was an inside bar, it was a reasonable thing to do. And then a bear sells more higher. I'll show this one more time. A bear sells here, they sell more below a bear bar, bar 9. And you look for their midpoint. It might be around the bar 12 low, which is just another reason there was support there. And look at that. It's so fascinating. Nothing is random. So breakout follow through, but possibly 3 legs down. So that's a problem for the bears. We might bounce here and get a deeper pullback. But at this point, the bulls know this is so disappointing that even if we do rally after this, and it is a breakout and then a deep pullback with 3 legs, we're probably not going to get back up to the close of bar 8. And it's more likely a trading range. 17 a bull bar. So bear breakout, and now the market's pulling back, maybe to test the moving average, maybe to test the high of yesterday or Friday. It's a good looking bull bar, but after 2 strong bear bars, it's not enough for the bulls to buy. It's too tight. And the buying pressure isn't terrible, but the context isn't great. So some bulls might buy above 17, hoping for a bar like 5, but knowing it's unlikely. 18, it's a good entry bar for the bulls, so if a bull bought above 17, 18 is a good entry bar. But what's the problem with bar 18? Trap traders. If a bull bought below bar 14, maybe a couple of bull bars strong enough for a second leg, they're trapped. They're trapped buying here. And look where 18 is testing. The resistance area where bulls got trapped. And then we paused on 19. So if this is going to be a wedge that works and it's this tight, you need 19 to be another bar like 18, but instead we're stalling. Might be strong enough up for a second leg, plus it was 3 legs down. And a pullback after this breakout, we're expecting some sort of second leg. But we know it's probably minor, and we're probably not going to get up here because of this disappointment. And the bulls will take what they can get. So let's look one more time at this. We know the bulls who bought the close of 8, scaling above a bull bar, might be 17. And look again where the market is stalling. Right at that midpoint. And so this might be the second leg that the bulls get. And it's hard to see. It doesn't look like a second leg. It's not symmetrical with this, but that's what's happening. 20 is a bear bar. It's a high 1 for the bulls, but the context is bad. We're at a resistance area for a couple of reasons. And overall, it's a trading range, and we're in the middle of the trading range. Might be breakout mode. You can call it a triangle. The range is contracting. We're getting lower highs and higher lows, but probably sellers above 20. 21, a bull breakout attempt. Closed above 20, but not above 19, and still within the tight trading range. Bull breakout, pause at resistance, maybe a small second leg, and then a reversal because there's sellers above these bars. 22, we had a bull reversal bar breaking above the triangle, but almost completely overlapping bar 21. It's not ideal. If this is a bull breakout, you want bars like bar 5 or bar 18. Bar 5 is a little climactic, but instead you're getting a breakout and then a pause and then another bull bar, deep pullback. This is a second leg on a smaller time frame. So it's actually 2 legs up, 1 pullback 2, and 1 pullback 2. It's a nested pattern. And then you have resistance above bars to the left. Most breakouts in trading ranges fail, and it's a triangle, so 50% of breakouts of triangles are the wrong way the first time. So for a couple of reasons, probably more sellers above 22, and then instead they sold the close in 23, was a strong bear trend bar, strong enough after 2 legs up, high in this range. There's probably more sellers below, but there are problems with that. As far as if you're long, I would get out of longs below bar 23. And some bears will sell below 23, taking a chance we get a swing down, but they know that they're selling at what could be support at the high of yesterday, but really at a magnet. And you can see the market's going sideways here, so you're selling in the middle of a tight trading range. And that's the problem. 24 reversed up immediately, but 24 still has problems itself. Look at all the overlap for the past. You could say all these bars are a lot of overlap, and especially in here, the past 5 bars or so. Every bar is overlapping another. So it's a tight trading range. It's a limit order market. You see something bullish, then they sell. You see something bearish, and they buy. So bear trend bar 23, traders bought below. Bull bar 24, probably more sellers above. Inside bar 25, probably sellers above, buyers below. And then a small trading range bar, again, a doji on 26. The market's in a tight trading range here. And you had this bull breakout, pullback, and then rallied again for a second leg, and then a pullback and a rally again for a third leg, and a possible double top with 23. So probably sellers above 26. 27, we did not get the breakout, but we tested the high of 26 to the tick on 27 and reversed down. You can call 27 a low 3. It's a low 1 below bar 19, low 2 below 23, and low 3 below 27. It's basically a head and shoulders. Left shoulder, head, right shoulder. So as far as being long, below 27 I would exit longs, and some traders will sell, taking a chance we get a swing down, because this, even though it's 3 legs, it's a parabolic wedge. And parabolic wedges lead to minor reversals, even though they can be deep. This is a minor reversal. Big up, big down, big up. This is not a bull trend. This is not a bear trend. But this was enough for a second leg down. This was enough for a second leg up, but the bulls got it, and they gave up at about their average price if they scaled in lower. The bears, if you just go to maybe a 15-minute chart, you would see just a couple of bear trend bars. It's a strong enough breakout that even a deep pullback should lead to a second leg down. So that's the danger with being long below 27. A third reversal attempt down after the bulls are disappointed in this area. A bear bar 28, not the strongest entry bar, and still stalling at the moving average. So the moving average is still support. But you see 28, you know the context is bad. If you're buying above 28, you're buying high in a trading range after consecutive bear bars. So bad stop order trade, it's a good limit order trade, probably sellers above. Some traders might buy below, betting it's low in this tight trading range, and that's okay to do. but I think there's a greater risk of the downside breakout in this context. Again, the market's in breakout mode, but it can stay sideways in a tight trading range for a long time. 29 broke below 28 and reversed up. Low in this tight trading range. We're testing the high of yesterday again and finding support. And it's more clear on a lower time frame, but the market's in a trading range here, and it's getting a couple legs down, a couple of legs up, a couple legs down, maybe 3 legs up, maybe 2 legs down. It's just going sideways here. But what that means is the market's in balance, and eventually there will be a breakout. And I do have that bias with the daily chart context, where we have a bad high 1 signal bar, where we're expecting sellers above the prior day's high. So I do suspect the bull breakout is less likely than the bear breakout. You can call it a double bottom on 29, and it's really a head and shoulders bottom here, left, head, right shoulder. And the problem, it's in the middle of a tight trading range. There's probably sellers above. They may not come in until above 27 or 23. It's a limit order market, and so traders, rather than selling in the middle, will sell high. So 30 going higher to find sellers, probably due to bears unwilling to sell, and less due to aggressive bulls buying. It's like a small vacuum test. It's not a very big bar, but it is a trend bar, and you can see it's testing near the top of the range, probably going a little higher, but the bulls will likely be disappointed, because disappointment is the hallmark of a trading range. And then no follow through on 31, so it's a bear bar, probably sellers above and buyers below. It's in the middle of a tight trading range, but breakout mode. So if you're buying below, you are taking a chance, because again, the risk of the downside breakout is real. This should get a second leg, and it hasn't yet. Bear bar 32, probably sellers above, but again, testing support, probably buyers below. Maybe 3 legs down. Exhausted bears, and it's really just sideways and low in the tight trading range. 3 consecutive bear bars. Good for the bears, but just barely closing below the high of yesterday and still within the range of 24 and all the bars to the left. So 3 bar micro channel, good for the bears, might be sellers above, but it's a trading range. And that context weakens the bear argument. 34 is a bull bar. It's a shaved bull bar, basically. No tail above or below. But it's possible this is a buy vacuum test of resistance. The odds were there were sellers above after a 3 bar micro channel, and we're getting high in the range, so there might be more sellers on the close of 34. 34 might be strong enough for its own second leg. And then disappointment for the bulls on 35. Bull breakout, but no follow through. Low 1 short for the bears. You can call it a low 2. It's a double top. And bulls, as far as always in trading in here, this is not always in trading. This is not an always in trading environment. This is a tight trading range. And this is breakout mode. And if you're trading like it's always in is for trading in trends. And that's the problem with always in on days like this. So if you're trading a day like this, you need to be thinking it's a trading range. Buy low, sell high, and scalp. And especially on a day like this, tight trading range, it's a limit order market. Probably sellers above 35. And there might be buyers below, but they may not come in until lower. 36, we triggered the sell below 35. Disappointing entry bar for the bears, but also not a good bar for the bulls. Do you really want to buy above a trading range bar, high in the trading range? Probably not. It might be the small second leg the bulls get, bull breakout, pullback, small second leg, and we just can't see it on this time frame, but the market did rally on 36. Probably sellers above 36. 37, tried to break out above and failed. A couple of dojis, really tight trading range. The market is searching for direction, We're in balance here, but eventually at some point, one side will get squeezed out. And if you look at the overall context and what we've been talking about today, you have bulls who bought up here and they're trapped. And you have bears. Some bear probably sold above 17 and they're trapped. Or bears sold down here and they're trapped. But you think about the day structure. I want to see if I can zoom out a little. Look at the overall past couple of days up to maybe where we are here, bar 36, 37. Big rally, but then a deep pullback. So big up, big down, big confusion, which means trading range. Obviously a trading range here, obviously a trading range here. What are the odds we get a huge bull breakout second leg over here rather than a test back down into this range? It's higher probability we get the bear breakout because this is where most of the trading has been taking place. The market's making it clear that every time we get around this price, the high of yesterday, it sells off. We get above it briefly for a couple of bars, but then it sells off. We try to get above it. We're hovering around it, and that's okay, but we're not rallying away from it. And the bears really only had one serious attempt down. And eventually, this is all a minor pullback. They should get a second leg to test down here. And ultimately, this is a trading range. We'll probably close these gaps. Another doji on bar 38. It's a wedge on a lower time frame. 3 pushes up, 36, 37, 38. It's a really minor pattern. Overall, just have to understand the market is in breakout mode, tight trading range. This is considered barbed wire. Look at the moving average, it's totally flat. Traders, if they're trading, should only be trading with limit orders. Sellers above bars and buyers below. But the buyers, why would they buy below bar 38 when they know they can buy lower in the range, like below this breakout bar 34, maybe below 24, maybe this gap, when this gap gets tested, or even the low of bar 17. Bear breakout 39, closing at the high of yesterday. Look at the past 5 bars. The bulls have not controlled a bar in 5 bars. You look at the past maybe 9 or 10 bars. The bulls have had a couple of bars, but the bears are controlling the majority of the bars. Not that it's very strong. It is sideways, basically. Totally sideways on the moving average. But you have to recognize the bulls have not done much, and now we're getting a bear breakout on 39. It's still a minor breakout. It hasn't even gotten below 33. But what about buying above 39? Of course not. It's a fairly big bar considering the range. So big bar, big risk. 5 bars without a bull bar. And it's a bad stop order, so good limit order trade above. 40. Minimum follow through for the bear breakout, which was a minor breakout. It broke out below 4 bars. Broke out below maybe 5, but closed below 4 of them. And then 40 was a doji, minimum follow through. But same problem for the bulls. Do you really want to buy above a trading range bar after 6 bars without a bull body in a tight trading range? Probably not. Now the bears have a bar completely below the moving average on bar 40. And that's a change in the market's behavior. We have not had that since here, bar 17. And then bar 41, traders sold the close of 40, and we're getting a bear breakout. It's a fairly small bar, maybe an average size bar, but it's closing basically on its low. And it's a 4-bar micro channel since 38. So good for the bears. What about bear channel? Well, I guess it's actually a bull channel. This is a higher low. So technically, you can see it as a triangle, which is breakout mode, and we're getting the bear breakout. You can argue 50% chance the first breakout's going to fail, and that's true. But when you consider the context, the bulls had this rally and then this huge deep pullback. And then in here, they had their chance. They tried to break out and they failed. And they couldn't even get above here for the rest of their attempts. So we're getting lower highs the whole time. Now the bears are getting an attempt. And bar 41 is actually a good bear bar. completely below the moving average, closing on its low. It's not climactic, with a magnet below. Follow through selling on bar 42. So bear breakout and follow through, but testing the low of the range. You can see where we're bouncing the close of bar 16, where bears who sold the close got trapped. So we're expecting a bounce there, and that makes sense, but this is strong enough that the first reversal up will likely fail and be minor. So this breakout probably will have a second leg and sellers above. Inside bar 43. That's weird. I should have bar 42 numbered. That's weird. 43. Inside trading range bar, probably sellers above. Micro channel. Can you argue it's a double bottom with 17? You can, but it's a really weak setup because the signal bar is weak. It's a trading range bar, and it's coming after a 5-bar micro channel, maybe 6 bars. So really not ideal. And then we got the give up bar on bar, 44? Big bear trend bar. It's a sell vacuum. We're getting low in a trading range, and we know this red line was a breakout point. And the gap got tested. Will likely close, probably going at least a little bit lower. Now for the bears. The bears got their second leg. Leg 1, deep pullback, lots of sideways, and then leg 2. So now the bulls might be interested in looking to start buying, but there's not enough buying pressure yet. Look at the past 10 bars. Bulls, or even since here, the bulls have had 1 bar in 13 bars. There's just not enough buying pressure. You can argue that's a bull bar, but it's basically a doji. Follow through on 45. Probably sellers above 45, but getting kind of low in the range. We could easily bounce and vacuum up to test resistance before the sellers come in. But tight enough down, you could probably sell anywhere and scale in and make money. 46 broke the micro channel, but it's a minor breakout. It's a minor reversal. There's no major trend line break yet. Probably sellers above, but it might be disappointing enough that you have buyers below because we're low in a trading range. It's a low 1 with a bull body. So bear reversal bar 47, but bad context. Triggering the low 1, low in a trading range. Is it a bear trend? It might be, but it's not clear yet. And with all the overlap to the left, you're taking a chance if you sell here. 48, another bull bar, but closing below its midpoint. But the past 4 bars have lots of overlap. It's a tight trading range, low in a trading range. Probably buyers below 48. Bears who are selling are taking profits, and they'll wait to sell maybe the moving average or some other resistance, maybe this breakout point or this breakout point. And then we got a bear bar 49, breaking out below the tight trading range. Good for the bears, but it's possible this tight trading range was a final flag. We're getting a bear breakout, but the context is bad. And you look at the support. Here's the big bull breakout. Look where we are. So the bears just barely breaking out below. 49 is a decent bear bar, but it's closing maybe 2 ticks below the big breakout, and maybe 20% of the bar is below the breakout. And so the bears still need follow through. And when the bears need 1 more bar, you know what always happens. They don't get it. So traders bought the close of 49, big bull bar 50. It's clear the market's going sideways here. This is not a bear trend. Big bull bar, but bad context. High in a tight trading range. Even though it's a big bar, it's overlapping many other bars. It's probably sellers above, scaling in higher. 51, they sold the close. Inside bear bar, but again, bad context for selling below. There's probably more buyers below, but they may not come in until below bar 50. Probably sellers above bar 51. Sideways on 52, in the middle of this tight trading range. Probably sellers above 52 and buyers below. Overall low in this trading range to the left, the bull breakout. But this is still concerning for the bulls because even though it doesn't look like a bear trend, this was a strong enough breakout that it will probably get some sort of second leg. 53 is another doji, so 3 consecutive bars without a bull body. In a context that's probably always in short, or below the moving average, the bears are controlling many more bars than the bulls. And then you can call it a double bottom on 53 with bar 49, but it's a weak signal bar in bad context, probably sellers above. Plus you have bulls, might have got trapped buying the close of 50, they're disappointed, they'll exit on any retest. And look what happened on 54. I don't know if it quite got there, but you can see what happened. Got close to that price, and then the bulls gave up. Now 54 is a low 1 at the bottom of a tight trading range, so not ideal. Plus it's a big bar, so big risk, and you probably have support below 50. So not ideal to be selling here. 55, a bear breakout, going to a new low of the day. But now you have a possible wedge bottom. The buying pressure isn't great, and you know what just happened here. The bulls who bought here got trapped, and they gave up. But the fact that the bulls had that chance, it damages the bear case. You're having less trapped traders. You still do have trapped bulls. You look to the left. This was a sizable breakout. The market moved fairly far. Bulls bought below here. They got trapped, never got a retest to the tick. So there still are trapped bulls in the market, and we haven't had a give up since that. So here's maybe leg 1 sideways and looking for a second leg, but not ideal to be selling here. Inside bar 56, the bulls hoping it's a wedge bottom, and then we rally. Maybe the minimum target, the moving average. But like I said, disappointing bulls to the left. The upside's probably limited, and we're in a trading range, or at least a bear channel. 57, breakout attempt of the inside bar, but not going far. So there might be buyers below. But the buying pressure is bad, and it's not wise to be buying yet. Limit order bulls are having a hard time making money. If they bought below 48, they made money, but where's the limit order bull made money since? It's pretty challenging for them. And if limit order bulls can't make money, that's a problem, and you shouldn't be looking to buy. 58, bull reversal bar, good looking bar, and nested wedge. But you have to consider the buying pressure and the context. We're below the moving average after a pretty big bear breakout. Probably sellers above the bar. 59, we triggered the buy and then disappointed the bulls, so they may give up below 59. 59, they'll argue it's a low 1, low in this channel, probably buyers below. But if I had to be in the market, I'd rather be short. So I guess it's always in short. And bulls, even though it might be always in short, there's enough two-sided trading that bulls will buy below bars and scalp. 60, we are reversing up after triggering the sell below 59. Micro double bottom, maybe a small head and shoulders top, left shoulder, head, right shoulder. Decent buy signal bar, but the pattern's minor. There's not a major trendline break. You can argue here, bear breakout, trendline break, lower low, maybe a couple attempts down, and we bounce. But the bounce is expected to be minor. The bears are controlling a lot of bars below the moving average, and besides bar 50, the bulls don't have many bars or any decent bars. And then we trigger the buy above 60 and then reverse down again. 61 has the same problem as 59 and 57, where it's like a low 1 short, but you're low in a channel, so not ideal. Bears, they're selling above bars and taking profits below bars. And then outside up, 62. But you know the problem with outside bars, and there's a couple problems with 62. Even though it's a good looking bull bar, it's easy to get trapped into buying bars like 62. They're good looking bull bars, maybe at the low of the day, maybe a wedge. And it's reasonable. You're buying below this breakout. There is an argument to be made for it, but when you consider what's happening in the most recent context, we have a bear channel completely below the moving average, with trapped bulls above, so open gaps, and then you're getting what could be a buy vacuum test of resistance. Whenever you get a rally in a bear channel, the bears sell it. Look what happened to bar 50. So then you see a bar like 62, you have to think twice before you look to buy it. Disappointing follow through 63. Testing the moving average. The bulls, they might get a second leg, but you could even argue that is a second leg and it's a second leg trap. How can it be a second leg? Well, we rallied from the low of bar 58 to the high of bar 59, pulled back, and then rallied again. It looks stronger, but that's sort of a hallmark of leg 2 traps. And just look to the left. What's bar 62 breaking out of? A couple of bars, but it's in the middle of a trading range or a bear channel, so probably more sellers above. 64, we're getting a bull breakout, so buy climax, pause, another buy climax. It would have been better if the bulls had consecutive bull bars, but bar 63 is a problem. We had a bull bar, and then the bulls scalped. Another bull bar, they're probably going to scalp. You look to the left, we're high in this trading range. We're back to this price where bulls got trapped. So this is actually a sell zone where there's probably resistance. Here's my bar 42. And then disappointing bar 65. It's an implied low too. It's a leg, pause, second leg, high in a range, double top. Decent signal bar, but strong enough rally. This will probably get a second leg. So the first reversal down is probably minor. Probably buyers below 65. 66, we tried to break out below and failed, but 66 is now a bad buy signal bar. So a bad stop order means good limit order. Probably sellers above 66, high 1 at the top of a trading range. And then overall, you look to the left, the last breakout was a bear breakout. So probably still always in short, if not high in a trading range. So okay to sell above 66. And then 67, trying to break out, but failed. But if you sold above 66, 67 is not your dream entry bar. But at the same time, if you're a bull, you know you're getting a second leg after this. Here's a pullback, and then that could be all you get for a second leg. The bulls get to a new swing high, and then everybody sells. What about selling below 67? Second reversal. You can. It's a micro double top with over here, but the signal bar is weak. There's probably more buyers below. Plus the signal bar is big, so big bar means big risk. Traders would rather not take the trade because it's already low probability. Inside bar 68 going a little higher, but it's an inside bar. Probably sellers above. There might be buyers below, but there's an increased risk. It's 2 legs up, high in a trading range. 69 bear bar, reversal bar closing near its low. For always in trading bulls, they have to get out below 69. It's a second reversal, high in a trading range, might be a bear trend. Bears can sell below 69 for a swing. 70, good entry bar for the bears, bear trend bar, crossing the moving average. First target for the bears, they're probably looking for a measured move of the double top. Here's the neckline, break below it, get to here, and then you look where it gets to, below the buy climax, near bar 61, an area where bears got trapped, an area of support. And then bar 70, as far as above the bar, probably more sellers. Pause bar 71. So we had a bear breakout, but 71 tested the breakout point. So if a bull bought below 69, they got trapped, but they had a chance to exit on bar 71. So not ideal for the bears. 72 going a little higher. It was a 5-bar micro channel since 67, so this broke the micro channel. So there were probably sellers above, and there were. 72 was disappointing for the bulls. But you know the bulls are disappointed up here, and this is an area of resistance. So probably sellers above 72. 72 is not a good sell signal bar either. Probably buyers below. 73 an inside bar. Probably sellers above and buyers below. But the problem with buying below is you have the second reversal. And you know the market is in a trading range. And I mentioned it earlier. When you have gaps open in a trading range, they're likely going to get closed. 61 selling above 61, a bear bar in a bear channel. You scale in higher, you're probably going to make money. Market's going to probably test that breakout point. It was a weak breakout. It was a bull, climax, pause, climax, bad follow through. And then the market's topping out. We have a double top, micro double top, decent sell signal bars. That's the danger with buying below 73. You're buying in the middle of the tight trading range rather than low. Outside bar for the bears on 74, but basically a trading range bar, probably sellers above, but same problem with buying below. Inside bar 75, IOI pattern, breakout mode, in the middle of a tight trading range. You can call it a triangle at the same time. But all this means the same thing. The market is in breakout mode. 76, bear, breakout. Big bear bar, but buyers into the close. You can see we're testing below the breakout 62, the low of the day, but probably going a little lower. The bulls haven't had a decent bar since 68, and it was an inside bar, so not enough buying pressure to be looking to buy. Even though it might be low in a trading range, the bulls need to do more. Deep pullback on 77, so bear breakout, deep pullback all the way up to the breakout point, so not ideal for the bears, but still nothing to buy for the bulls. 78, a big bear breakout bar. It's a shaved bar. And that's good for the bears, but overall it's been a trading range day. So what are the odds this becomes a sell to close end of day sell-off? It's pretty unlikely. More likely, you look at most of the trend bars today, and they're met with disappointing follow-through. Bull breakout, bad follow-through. Big bear breakout, bad follow-through. You see it all day long on trading range days. 79, it's a doji, minimum follow-through, but closed above its midpoint. Probably sellers above. Bull bar, probably more profit-taking than buying, and probably sellers above. And then 81, inside bear bar, sideways into the close. For always in today, I wanted to mention the Globex chart. Look at the extended hours of the Emini. It's helpful to look at the Globex when you're coming into the open of the day. Because remember, Al says 50% of breakouts on the open, no matter how strong they look, will reverse. And so here is, I'm looking for the open of the day, 9:30 right here, Eastern time. This is the open of the regular trading session. And look at this market. Is it a bull trend? Is it a bear trend? Well, obviously the market's sideways. It's a trading range. And so here, remember this is the 15-minute chart. Big bull bars, but you know the market's in a trading range. So you get above a swing point, there's probably sellers above. So that really damages the bull case. And you had other context clues like the high of the prior day on the daily chart being a bad high one signal bar, but looking at the Globex chart is also really helpful coming into the day. So if we're always in long, it's a big rally, but the context is bad, so that worries me. So it might have been always in long on the close of bar 5, big enough breakout, probably going higher, but the context is bad. You're right at yesterday's high, and then the context again, even for a breakout up here, can be dangerous. And then, was it ever always in short in here? I don't know. It's kind of hard to tell, especially when the market is in a trading range. It's big up, big down. So I think once you get 3 legs down, and then probably the close of bar 17, even on 16, by context, it's probably always in long. But then 17, you see the bad follow through on the bear breakout. It's probably always in long here. But it's always in long for a scalp, and that's because the market's in a trading range. So for me, better to think about it as buy low, sell high, and scalp. All through here, really tight trading range, not always in. Eventually, we started to get a bear breakout, and by bar, maybe 42. The bears finally got a bear bar, or a bar completely below the moving average on 40, then bear breakout 41, follow through 42. This might have been always in short with the risk that we're low in a trading range. But look to the left, you can see this might be low of the trading range. Minor reversal, and then big bear breakout. So is there ever a reason if you are short to exit? Even if you wanted to exit above 43, you never got triggered. And then here, you probably exit always in short above a big bull bar like that. Even though the context is bad, we know it's high in a tight trading range, never triggered. And you had a chance to exit near the lows. And it was still just a trading range for the most part today. So not ideal for always in. Stop order trades today. You can buy above bar 5 taking a chance, but again, high in a trading range. So the management for that trade has to be fairly quick. You give the trade a little bit of time to go, and if it hesitates or pulls back, it's not doing what you need it to do, and just get out. I thought buying above 17 was a reasonable stop order trade. Decent bull bar after 3 legs down, after a big breakout, which should get a second leg. And then there were stop order trades in here for the bears when you can take a chance, selling below 27, selling below 31, and then selling below 35 or 38. Betting we get what we got, the downside breakout. Disappointing enough, pullback by the bears for the bulls here. This ended up becoming a lower high, and you can see it as a lower high major trend reversal. Bull trend, trend line break, retest of the highs. We really just got to the average price for the bulls around here. If they bought the close of 8, scaled in lower, went sideways before finally getting the give up by the bulls. Stop order sell below bar 41, good bear breakout bar, and then follow through 42. What about selling 44? I don't know. It's a big bar getting near support. Probably better to take profits there, and if you do and it goes a little lower, you don't beat yourself up about it. What about buying above 58 or 60? I thought it was okay. You know, it's a minor pattern. There's 3 legs down, probably low in a trading range. It's not the worst trade in the world. But then here, bull bar 62. What about buying above it? Your buying might be high in a range below the moving average, so not ideal. And same with bar 64. I thought it was too tight up to sell below 65, but I thought 69 was a reasonable sell, especially for bulls to exit and bears can sell for a swing. That's about it for stop orders. Limit order trades today. Probably sellers above bar 1 and then buyers below bar 1. Traders probably could have sold above 3, but you're in the middle of the range, better to sell higher. Maybe buyers below bar 11, but again, not ideal. But it is an inside bar, and you're expecting a second leg after the rally. And then bear breakout of this swing point, and then bulls made money. So what do you think is going to happen here? The bulls will buy it. The bulls will buy below bar 12, and they made money. Big enough rally up to 18, should get a second leg. This is a bad low 1, buyers below. And then all in here, I won't even go through all of them. It's really just a limit order market, tight trading range. You can sell above bars and buy below bars. Until over here, the bears finally won. The bulls who bought got trapped, and they're forced to exit. Over here, pretty directional. You know the bears will get a second leg. Sellers above 45. And then sellers above 49. Buyers below 50. They don't come in until over here. Bad reversal above 53. Sellers above. And then sellers above 65 on 67. Not a good buy below here. This is probably a trading range. We're high in the range, so this is a sell zone. Sellers above the high 1, 71. Outside bar, there were sellers above the inside bar, still high in the range. And then obviously the downside breakout. That was about it. As far as tomorrow, where do we go? Well, we look at the daily chart. and it's easy to think parabolic wedge, 3 pushes up, an outside bar for the bears closing near its low, and 3 consecutive bear bars. We're going to get down to the moving average. It is possible we do, but you remember when we actually look at the bars, when you crack open the daily chart bars, the market's been mostly sideways, so it's not as bearish as it might seem. And then you had bears selling above the 14th high, so that becomes a support area. So I suspect if we do get to the high of this bar, which we got close to it today, we'll probably bounce and find buyers because bears who sold here got trapped and disappointed. As always, please feel free to leave questions in the comments and include timestamps for any questions specific to this video. And with that, I hope everybody has a good rest of their night. Thanks for watching.